Welcome to Three Devs and a Maybe. Now introducing your show hosts, Michael Budd, Fraser Hart, Lewis Gaines, and Ed Mann.
Hello and welcome to another episode of Three Devs and a Maybe. My name's Ed Mann, and today we're joined by Jay Smith. How you doing, Jay?
Yeah, I'm good. How are you?
It's almost like we've done this before, deja vu. This is always the thing that happens when I start recording. I think, well, I'm going to ask you again how you're doing, as it's like, on record. So, it's almost like, are you saying the same thing as before, or are you lying to me? I don't know.
Well, there's plenty we haven't spoken about yet, so.
Yeah, exactly. Absolutely. Yeah. So just a little backstory for the audience. So as the audience, I've been getting very much into Bitcoin, like a lot of people are at the moment. I'm specifically getting into like the internals of it, kind of more than like kind of the outer crust of it. I'm more into like how it works under the hood and kind of how the blockchain, and all these kind of things and the game theory behind it and stuff is working, and super interesting, super interested in it. And one person actually on my Twitter feed that I met a couple of years ago for a friend, actually, he kind of, you, Jay, you kind of start, you kind of talking about this stuff. And I'm like, hang on a minute, not many people I know talk about this stuff. And you talk, you have some very interesting insights. And you actually are a trader in the cryptocurrency space. And looking at your website and everything, you seem to be kind of, been around, with the cryptocurrency stuff for quite some time. So I thought it'd be really cool to get you on the show and kind of pick your brain on a lot of different bits and bobs.
Yeah, no, I got into cryptocurrency pretty early.
Which is very, very good.
yeah.
So how did you get into it then? What sparked your insight into it?
So a lot of people ask me this, and the answer is somewhat disappointing in that I don't actually remember where
you can make it up though. This is great. You can just make it up.
I don't remember where I was first introduced, but I was in all of the kind of circles that got involved with it quite early. So I've always been into like futurology, which is effectively the study of future technology. And so obviously at that point in time, blockchain was a future technology that people were kind of looking at and saying, oh, this could be a thing. I've always been into esports, which is an early adopter for pretty much everything. Esports is what pushed, live streaming to become a thing that is now on Facebook and everywhere else, YouTube and whatnot. So I was just kind of in the right place. And I think I just kind of fell into it. I spent probably about 2 or 3 days just studying how it works, as you said earlier, the game theory and what the incentives are for the miners and for the people using the network and how the value grows and stuff. And it just kind of made sense to me, so I started pouring my paycheck into it every month.
So did you get into any of like the mine? Because I suppose, but when you got into it, was mining still actually like a thing you could do on GPUs and stuff? Yeah,
so we were probably about like halfway through the GPU era, as I'll call it, on Bitcoin. And I actually had an AMD graphics card in my PC at home because, as I said, I play a lot of games. So yeah, I started mining. I mined for about 6 months, and I think in total I earned about half a Bitcoin off of one graphics card.
Which is worth something now. I mean, that's nothing to scoff at now.
No, indeed. In hindsight, probably should have kept it on for maybe another month or two, But towards the end of that time, the ASICs were coming out. It was the time when there was Bitfury and all this stuff. There were a lot of scams actually around it where people were paying a Bitcoin to buy a mining rig, and then it just never arrived. And they're probably missing that Bitcoin about now.
This is the funny thing now, isn't it? So I mean, the funny story obviously is that one of the highlighted ones that all the press make out is the pizza situation, where someone paid like 10,000 Bitcoin for one pizza, and that is an expensive pizza now.
Yeah, incredibly expensive. It was a British guy that did it actually. It was an American that put up a post on Bitcoin Talk and asked for a pizza. Asked anyone to buy him a pizza, and someone replied from the UK, and they phoned America to order a pizza for him.
Absolutely fantastic, because wasn't it the first like transaction, like business kind of like?
Yeah, it's the first transaction that really kind of gave it a value in people's heads.
It gave it a pizza value.
Yeah.
So following on from that, then, so how did you get into like trading and stuff? Because that's another thing that you talk a lot about on your Twitter feed.
Yeah, so I had started trading pretty young actually. By the time I was like 14, I was watching CNBC and Bloomberg in my spare time and kind of making virtual trades on spreadsheets and just kind of looking at how I would perform if I was actually trading. I didn't have any money to trade, obviously.
That is amazing.
By the time I was 18, I got a small lump sum of money and started trading with it. So like, £500 or so, £1,000, somewhere in that range. And yeah, I just never stopped pretty much. And it's just kind of slowly grown and grown and grown from there. And my family were incredibly skeptical at first. My mum thought it was gambling. My dad thought that that it was just random and that I'd grow out of it. And then he started kind of getting involved, and he actually copies me now. So
that is insane. That is brilliant. There you go. That's one way to win them over, is by earning money.
yeah, definitely.
So what actually, for the naive like me, kind of thinking about trading, like, it's a very, I would maybe class it as a very kind of volatile thing. Like, I mean, there's wins and losses and stuff like that. And obviously it sounds like, you play the game, intelligently, if you can, it's not gambling if you know what you're doing, or if you think, you have like kind of, things to back it up, where is it being used or whatever, you kind of things behind it. So I'm just wondering, what actually is trading?
So effectively, there's two main schools of thought on how to trade. One of them is called fundamentals, and one of them is called technicals. And so they're these two different schools of analysis, basically. So fundamentals is basically about news cycles and looking at who's working at the company, what's their previous track record, what kind of things are they looking to do, and a bit of speculation on where you think that could go. So you could say, well, Facebook has this massive social media network, then maybe they're going to make a Netflix competitor. And you kind of think about things like that and do these thought experiments about where a company is likely to go based on the people that work there and previous news and things like that.
So like new hires and stuff that come in and stuff, you follow them and work. That's cool.
Yeah. Only at the top level, so like sort of board level. You don't like every single person Facebook. You're on LinkedIn.
Everyone coming in.
Yeah.
They're looking at their GitHubs and vetting them.
Yeah. So that's the funny thing. You mentioned GitHub. So on cryptocurrencies, GitHub is actually kind of part of fundamentals. You go on the GitHub and you look at how many people are committing to the code and what other projects they've worked on in the past, all these kind of things. So you kind of get an idea of how big is the team that's building this, how much experience do they have. Are they building things totally different to what other people have done? So that's kind of how you evaluate cryptocurrencies compared to normal things. Technicals, on the other hand, are basically it's almost like game theory and a lot of mathematics, but basically for charts for currencies and stocks and commodities and everything else, most people use a candlestick chart. And on there are a bunch of tools that various mathematicians and traders have made over the time that effectively have become kind of self-fulfilling prophecies in predicting price movements. So there are very common patterns that occur multiple times in a chart, and you can look at pretty much any stock on the planet or any currency, and you can look through it and you'll find these same patterns reoccurring over and over again. And so technical analysis is basically pattern recognition and trying to predict which patterns are coming next and how to buy in or sell at certain points in time based off of that information. So I use a combination of both.
Nice, yeah, because obviously in that case, so there's two things there. So with the cryptocurrency stuff, saying looking through GitHub and stuff, obviously a big thing there is white papers and things like that. Everyone's sending out white papers and kind of asking for money and whatnot. And obviously then it's the actual implementation stuff. So looking at commits, looking at who's active, looking at their track records and stuff. So does that kind of looking at the internals and stuff like that really you benefit from having an understanding of code, an understanding of kind of what's 100%. Different from this?
So I'm actually not a developer, which is kind of weird for a lot of cryptocurrency investors, especially the early ones. Most of them were developers, and I'm just not. But I've always kind of been around developers. I know a lot of developers. I know most of the the basic lingo of what a stack is and all the rest of it. So yeah, I look through GitHub and kind of just look a little bit at their backgrounds. I can't look at the actual code, really. I can understand some bits of code in smart contracts and things because they're quite easily readable for Ethereum. But yeah, having that skill is definitely something that's really, really useful. And even if you don't have that skill, utilizing other people that do can be a really good way of trading. There's a guy on YouTube called Ivan on Tech, and he is a developer that just goes through code of cryptocurrencies and explains it to people.
I've heard of him, yes. So. That's cool. No, that's really interesting. And obviously then looking through BIPs and stuff like the Bitcoin improvement proposals and stuff and seeing what's going on there.
Yes, that's very important. That's very, very important. Same thing with Dash as well. Dash has got effectively a fund built into it that people can propose ideas to, and people vote on what to spend that money on. The community that owns Dash votes on what to spend the money on. So anyone can propose anything, and it's really interesting to see what they do. So at the moment, they're advertising on flights across the Atlantic, for example. You go on a flight and you watch a film, there's a Dash advertisement in front of it.
Oh, that's insane, man. Yeah, this is it. This is the boom, isn't it? And, it's such a volatile market now. And I mean, we've had little spikes in the past, and I would say like I've only got into it probably 6 months ago beforehand. And naively of me, I kind of I dismissed it like as a technology. I didn't really look into the internals of it until I was like, well, this is quite interesting. And distributed ledgers. And I was thinking, how do you deal with a distributed trust and trustless, how can I make a system where I don't trust you? I have to verify everything myself. And we're all, kind of in it together, and incentives around that. Like, why would someone want to not screw the system, or, what's behind all that? Yeah. So why is it such a volatile market at this time?
So I think it depends on how you measure volatility, on if it even is volatile. So if you measure volatility based on how much it fluctuates on a daily basis, it's actually no more volatile. In fact, it's less volatile than something like Twitter, for example. So on a daily basis, it's not volatile at all. Of course, if you look at a year view, then Bitcoin goes up, 500%, and something else goes up 5%. There's a bit of a difference. But I don't think it's really volatility. I think the trend in cryptocurrencies, especially Bitcoin, has always been this parabolic upwards curve, effectively. So it all kind of revolves around the network effects. The same way that Facebook grew is the same way that Bitcoin is growing now. You have the early adopters that are able to use it when it's clunky and terrible and buggy and broken, and are just kind of interested in the technology. And then you get the next set of people that come in and they're like, oh, this is kind of cool. Maybe I can build something on top of this. Maybe we can help build the infrastructure for it. And then you get the next people that build the really customer facing stuff. And then you get the customers. And I think we're kind of in that sort of phase now. It's very comparable to the dot-com bubble. But Bitcoin itself is a deflationary currency, effectively. There is a limited supply that can never be increased. And that means that the value, in theory, as long as it is still useful and has utility, will continue to go up.
When we say volatile market and we're talking that the price of it's gone up, is we are comparing it and basing it on fiat currencies. Yeah. And, looking at it from the idealistic, what actually is Bitcoin. I think that's kind of, for me, the most important thing. Like I love, obviously everyone would love to make money and stuff, but really, do you want to cash out into fiat, or do you believe in cryptocurrencies and you want to actually be paying for stuff in cryptocurrencies? You hear people who say buying a pizza, or some people buying a Lamborghini or a house in Bitcoin. Yeah. And to me personally, that is actually what I would love to do. I do believe in the cryptocurrency. Now, whether it be Bitcoin, whether it will be a successor to it, obviously everyone's trying to make a successor, or at least trying to put their own spin on it at this time. But what actually then is Bitcoin, and kind of some history around that?
So Bitcoin, to give the basic explanation, Bitcoin is what you said earlier. It's decentralized trust. So you have a system whereby you can send a token that is worth whatever value it's worth. People can put their own value on it. That's effectively what the market does. You can send a token from one person to another in what is effectively just a big spreadsheet, a big ledger. So you have a bunch of addresses in one column, and then you have how much is assigned to each address in another column. And the network overall of nodes and computers that are running full nodes, basically, which basically means they're storing the entire thing, are updating in synchronization with each other to make sure that no one can edit that and say, I've got 10 Bitcoins instead of I've got 1 Bitcoin, for example. And so this happens through blocks, which is where the blockchain bit comes in. So you have blocks that are 10-minute periods of time, basically, in which a bunch of transactions go into. And so those transactions get verified. They get put in there by the miners, effectively. They're effectively picking the transactions, taking the transaction fee. And once it's in there, that block is cryptographically sealed, basically. So you cannot go back and change anything that has happened in that block. Once a transaction is done in Bitcoin, it is final. It is not reversible. But that's also how the trust works because of that, because of the fact that you know that there is no way that someone can reverse something. If you could reverse a transaction, 4 blocks ago in Bitcoin, then that has a ripple effect on any transactions linked to those accounts in the future, which is why you can't do it.
Absolutely, yeah. I mean, and that's the thing, the beauty of the blockchain, and why a lot of banks, probably they don't like the idea of the currency of Bitcoin, but they love the idea of the blockchain, and a lot of people are trying to apply it into different things. And it is a beautiful system where it's just a linked list, as you say, of blocks that are just every one of them hashed on top of the other, just to make sure that we can't tamper with previous ones. And, talking about like the game theory and the incentives behind it, like what are the incentives then for people to play the game nicely, like to run, the same node software and, to mine, etc. and whatnot?
So this is actually where things get interesting. So mining is pretty simple. There is a limited amount of space in every block currently. If we're going to exclude SegWit for this conversation, there's a limited amount of space in a block for transactions to fit in, and so that means that everyone has to put in a fee after you get to that maximum number. And so the fee will go up when it's during busy periods, or if you really want your transaction to be confirmed quickly. Or you can put in a lower fee if you don't mind waiting maybe an hour or something. But basically, the miner's incentive is that all they really want to do is make money. They earn Bitcoin by verifying transactions. They also have to make sure that they are in sync with everyone else, because if they're not, then they're just wasting their computing power, because the overall network has to reach a consensus. And whoever has the longest chain, as it's known, wins, basically. So it's the people that are all agreed and that are effectively computing next blocks fastest. So that basically means that if you were to attack the network, so let's say that you bought a bunch of miners and you wanted to basically mine a block and then change some of the transactions in it because you mined it, right? You can prioritize which transactions get in there and which ones don't, and things like this. You would have to have more computing power than 50% of the network. It's known as a 51% attack. And the Bitcoin network is more powerful than the top 10 supercomputers on the planet combined right now. So it is basically impossible. Basically impossible. It's never happened on Bitcoin yet.
And I think that's the thing. The incentives with it is that, you are using up, like a miner is using up their own money in electricity and in compute power and, using up that hardware to do this. So to attack the system and the node, you're detrimenting yourself.
Yes, you're costing yourself a lot of money.
That's it. So you must have a good use case for it. And if you don't abide by the rules, people are just going to ignore and disregard that block and go on with another chain.
Yes, exactly.
And because when you think about this, and this is one thing, reading the white paper, you think that this is a great idea. And then you think, yeah, sure. Yeah. And you just think of, maybe as you say this, where people are going to, maybe there'll be attacks and all this. And you think, well, this is great, but people are going to find ways around it and whatnot. As time has shown in practice, it's worked. And I think that's the best thing about Bitcoin is it's still here. People have their websites, the obituaries of it and everything that it's going to die, but it's still here. People haven't. It's a honeypot that, it's the biggest honeypot because if you hack it, if you be able to try and, break it, you're going to get lots of money out of it. I mean, even more so now with the amount of money that's been pumped in, to it. It just, the confidence grows with every block. And it's just a fascinating system where one guy or one girl, someone, pseudonym, Satoshi Nakamoto, decided to make the system that works in the practical world where, a lot of things which can be theory just never come to fruition, but this did. And this has been working. And I think that's where people have really shone a light where they're like, oh, it's still here and it's still chugging along.
Yeah. I mean, it's almost been a decade now. I think a lot of people don't realize that this was created following the 2008, 2009 financial crisis.
And it's actually in the Times, isn't it? There's the Times block.
Yeah. It's crazy. It really is crazy that it's survived this long without having any major issues whatsoever. There have been issues on some other cryptocurrencies, like there was the DAO incident on Ethereum. But that's also kind of a cool thing about what this has led to is that the fact that it's open source is probably the most important decision that was made about Bitcoin. If they made this system and it was closed source, like it would never have worked because people couldn't verify the code and stuff. But also it doesn't allow for people to innovate and try and create different versions and different ideological versions of it even. So, I've seen some of the really early cryptocurrencies that were created. There was one that basically had a time limit on how quickly you had to spend your coins before they just got destroyed. And it had a much higher inflation rate. And so the idea is it's trying to power this, consumer economy where you get money and you have to spend it, which is a really cool idea to play around with. And it's given people this massive sandbox where they can do this kind of stuff. It's really, really interesting.
obviously then trying to split Bitcoin, the currency, from the blockchain technologies. So, I mean, it's very hard too, because obviously a lot of the blockchain technologies require this idea of either tokens or a currency of some form, a coin of some form, to be able to, run the system for incentives and stuff.
Yeah.
But actually Bitcoin as a currency, how does it actually change the way then we view money and that we want to bank and stuff? Like, what is the vision behind it?
So I think the original vision from Satoshi was that he wanted Bitcoin to get to a point where if you ignore any scaling issues, everyone can use it on their mobile phone, on their PC, on anything with an internet connection, and in theory even beyond that with things like paper wallets and things. And you no longer need that middleman. That's the key thing that Bitcoin does that people often forget about, is that you don't have a middleman. So right now, if I want to send money from here to my friend in Argentina, that's going to cost me a substantial amount of money, and it's probably going to take about a week to get to him. But my friend in Argentina has Bitcoin. He has a Bitcoin wallet, and I can send him Bitcoin, and it will arrive to him, even with a low fee, within 2 hours. And if I prioritize it, or even if I use some of the other different chains that are available or services that are available, it can basically be instant. I can send him money within 2 seconds across the world. Nobody can stop me from doing it, and that's the big innovation that Bitcoin was kind of designed for. The underlying technology, blockchain, of course, can be used for a bunch of different things, because there's nothing really to say that it has to be money that you transfer. It can also be data, and that's where a lot of corporations and things are starting to get involved and starting to look at how they can potentially use it for supply chain management and things like that.
So you mentioned actually, the Bitcoin is a finite currency. It's finite. It has a finite supply, and that's unlike fiat currency.
Yeah.
So would you mind kind of like spelling out the difference between the two?
Yeah.
And kind of like how they work?
So effectively, fiat currencies are managed by a central bank. And in most cases, actually, the central bank isn't even like attached to the government in any way. It's like this self-contained unit that the government go to and ask to do different things. And they normally agree. Sometimes they don't, but normally they agree. And so the way that it works is that, generally speaking, most governments tend to run budgets at a deficit quite often, which means they don't have enough money to pay for everything. And so they go to the central bank and they say, well, we don't have enough money to pay for everything that we want to. Can you print a bit more? And so that's what the central bank does. They print a bit more. They
turn on the printers and they start.
Yeah, they turn on the printers, and this is what inflation is. So when you hear inflation, most people actually associate it positively, because they think of their bank account and they think, oh, I'm getting 1% inflation a year or 2% inflation a year. That's great, that's free money for me. In reality, unless that number is higher than the inflation rate for the entire country, and the same goes for your salary, then you are actually losing money, because more money is being printed, which means that everyone's money is being devalued effectively.
Isn't it a game that we'll lose eventually? Like,
in theory,
I mean,
yes.
obviously, yeah. Because I'm holding. Funnily enough, I was sad enough to buy. I bought a couple of Zimbabwean notes, dollar notes, just for some historical perspective. And I am a trillionaire now, so I do like the fact that I'm a trillionaire. My girlfriend thinks I'm an idiot with it, but I just thought it has to be done. And obviously, that is where hyperinflation and inflation just goes crazy, and the printing just carries on and on and on.
Yeah. So that's the situation that happened in Germany. Japan has come very close to it recently. There's a lot of people would think that hyperinflation is really just around the corner for the global economy, because once one of the major economies go into that kind of period of having to massively increase inflation just to keep their society going, then effectively that will have ripple effects on the rest of the world, because we're so much more connected than we used to be. But basically, hyperinflation usually occurs because a country has an awful lot of debt and it just can't afford to pay it. And the thing about the inflation is, when the bank prints this money, they say to the government, you have to pay this back. And obviously that doesn't work, because they've just printed the money. So unless the government can also print some money to then give that money back to them, there's no possible way of paying it back because of the interest that is on top of it. So eventually, in theory, the system should collapse. Now, it's lasted a lot longer than a lot of people would expect it to. Every year there's another conspiracy theory about a country here or there that's about to go into hyperinflation, but it doesn't really tend to happen very often. Venezuela is the most recent example of where it's happening. which ironically is a place that Bitcoin is very popular. But yeah, I think it's something that's misunderstood by people quite a lot, actually, and I think it's something that really the wider public needs to be taught about. And if you're listening to this and you still don't understand it after this, I really urge you to just do a bit of research. Like, there's a couple of documentaries or whatever you can go and find to watch about this stuff, and it will teach you exactly what's going on and why it's bad for you, unless you are one of the lucky people that gets a nice pay rise every single year.
It's absolutely insane. And this does then bring on to, the fact of them being finite and treating, like, say, like Bitcoin, where with like gold, where there is a finite supply. I mean, one thing with Bitcoin actually that really, turned my head as well was the fact that we take money for granted. We take the concept of money or value for granted. And I know I do. You just think of money and you think, well, this is just, and it's just kind of an underlying thing within our kind of world we live in, that we have money and that this is the way it works and stuff. But working out what is value and why it costs, what makes value. And then that really with Bitcoin, because it's something that's completely trying to shift that and disrupt that kind of technology and that kind of ideology, it really does make you really rethink that.
Yeah, definitely. So I think the main thing that really gives national currencies value, fiat currencies, is the fact that we have to use it, right? We are told that if you go to a shop in the UK, you have to spend pounds because that's what they accept. If you try and give them a dollar bill, they'll say no. And that's because the government has said you have to accept pounds. That is legal tender in this currency, in this country. And the same goes for taxes. We will only accept pounds for taxes. Now, this situation is about to become very interesting because, as you are probably quite well aware, with Bitcoin, no one can force you to spend money. No one can forcefully withdraw it from your account. And you can't necessarily, if you're very careful, even tell who owns a wallet. And so what's going to happen is there's going to be a bunch of people soon that are making a lot of money from capital gains tax. And some of them will say, no, I don't want to pay tax. And the government will try and, force them to do so. And what will probably happen is that the government, although they keep saying that they're not going to support Bitcoin because they want their national currency to be the main thing, will have to do so in order to entice people to start paying some tax. So it's going to be a really, really interesting situation to see how different countries approach this problem. You've got some countries which are really embracing it and saying, yeah, we accept it now. We're going to, make it super easy for you guys and all the rest. And you should base your companies here, by the way.
Exactly. We're going to get some money out of this.
Exactly. And then you have other countries which are going the opposite direction, saying, no, this currency is not even legal to use here. If you're caught with it, like, we will arrest you and we will seize your computer and try and get access to it and all the rest of it, which has happened in a few countries. It's happened in Russia, for example, and then they reversed it and then they changed it again. And but realistically, the truth of it is that nobody really knows how this is going to affect things because, as you said, we have this currency that now is going up in value compared to everything else that we used to think had a lot of value. We used to think that the pound was a really good, stable currency. But when you compare it to Bitcoin, it's really not. I think Bitcoin has exposed just how little things are worth and how much we are effectively being ripped off by a very small chunk of people in the world that are controlling these kind of things and have influence over it. Even if you think about it from a banking perspective, when the money is printed from a central bank, the first place it goes is to the banks, for the banks to lend out to people. And so because they get access to it first, effectively they feel a dampened effect compared to everyone else on what it has on the economy, because it hasn't trickled down through the entire economy yet. They get free money to lend out to people, and they get to charge interest on that. So they're making money on something they didn't even have. Whereas when you get that money, when that money finally arrives to you, you don't have that impact because you have to go and spend it somewhere. You're not making money off of it, probably. It's a really interesting topic you could talk about for a long time. Yeah.
Yeah, no, it really is. Absolutely. And I think that's the beautiful thing about it, which, other than, obviously the technologies that are working because, it's still around, it's the fact of how it's going to affect, and it's changing the way people perceive money, the way perceive banking, the way you look at things and stuff. And you just, things that you've taken for granted, you kind of, twist them around and just see what can be through something like this. And, the fact that, it was the old client server nature of a bank where they're closed off and we just get what they tell us, essentially, where now it's an open source protocol like Bitcoin where anyone can see anything. Anyone can vet the code. Anyone can write their own version of the code. If more people want to use that version, great. It will carry on using that. But it's very much kind of just like the open source movement of Linux and all these, and how have they ever worked, and all this. But it works because the vast majority will have a consensus on it and carry on. It's just it's an absolute fascinating piece. Moving on from that, then the other thing is, obviously we've kind of highlighted it, is the blockchain, and we've kind of discussed some bits in there. But it's one of the big things, obviously, with Bitcoin, and Bitcoin drives a lot of the prices of other currencies or altcoins and things. And those are places where people are getting, people who missed, in quotes, the big Bitcoin kind of hodling and stuff, or whatever you want to call it, from the past. They're trying to make wins now, and you get traders and stuff who are playing a lot with these, and people are pumping and dumping coins and stuff, and you'll see a lot of YouTube videos of people talking about coins that they'll pump and dump and all that horrible things and whatnot. And you'll get things like ICOs and things like initial coin offerings. And I'm just wondering, kind of like, for you, what are kind of some of the main altcoins that have appeared and have stayed around and that have some true value?
So one of my favorites right now that I've been talking about quite a lot recently is Dash. So Dash is currently, right now as we're recording this, the 5th largest cryptocurrency behind Ripple, Bitcoin Cash, and Ethereum and Bitcoin. And Dash was actually originally a fork of Bitcoin that then turned into what was called Darkcoin, and it was primarily used actually on the dark web. So this was after the Silk Road incident happened, and the FBI caught him, and people realized, Bitcoin is actually reasonably traceable. You have to be very, very careful not to be caught. A bunch of people created Darkcoin, which basically has a mixing service built into it. And then that later evolved into Dash, and rebranded into Dash. And Dash actually has a bunch of really innovative, cool ideas. So earlier on, I mentioned that it has a fund. So currently, Bitcoin, the way it works is that miners earn 100% of all of the fees that go to creating new blocks, basically, verifying transactions. With Dash, they've split it. And what they've done is they've given 45% of it to miners, exactly the same as Bitcoin. And they've given 45% of it to masternodes, which I'll explain in a minute. And they've given 10% of it to this fund in the middle, which is a DAO, a decentralized autonomous organization. So what this means is that basically this money all goes into an address, and that address is a multi-sig address. So it can only be spent from that address if lots and lots and lots of people all sign to agree to spend it from that address. And the people that have the power to do that are the masternodes, which again I'll explain in a minute. But basically this fund is designed to be a marketing fund for the entire currency. And most of it at the moment is actually being spent out in Africa to educate people in Africa and actually give them some free Dash in countries such as Zimbabwe and Kenya and a bunch of countries around that region where everyone has a smartphone over there now, and everyone has even 4G actually in most of these countries, but they still have a terrible banking system. In fact, most of these countries don't even have banks. People are used to trading the physical currency, cash in hand, and even started to innovate in things like mobile minutes where they transfer minutes to each other. So Dash is spending a bunch of money over there to try and start educating people over there on what a cryptocurrency is, how to store it on your phone, and how to transact with other people with it, and how easy it is. And that's what that fund's going to at the moment. So the people who vote on the fund, the masternodes, earlier on we mentioned that Bitcoin has miners which verify the transactions, but miners don't necessarily need to store the entire blockchain. And general users don't need to store the entire blockchain. So a node is something that stores the entire blockchain on a PC somewhere, connects it to the internet, and just opens it up and says, hey, anyone, if you want to see what the current state of the blockchain is, I'm open. You can connect to me and have a look at it. And so Dash realized that there's a problem with scaling potentially on Bitcoin, in that if the block size increases and things like that, then it becomes quite costly to run a node. You have to have an internet connection that's dedicated all this time. You have to have effectively a dedicated PC, even if it's something really small like a Raspberry Pi. And most importantly, you have to have a lot of storage space because, It's not incentivized at all. No one gets anything from running a node on Bitcoin.
Apart from the good warm feeling, you go on like Reddit and stuff and say, I've just made a new node. Look at me.
Exactly.
Yeah, thank you.
Exactly. I've done that a couple of times. But at the end of the day, there will come a point where it's costing people a lot of money to do it. And the only people that will be interested in doing it will be the people making money out of cryptocurrency. So that's why miners do it. And that's why some of the big cryptocurrency companies do it. And then you have the good people doing it out of the generosity of their own heart. But Dash realized that this could potentially be a big problem in the future, and so they created masternodes. And masternodes basically are people that get paid for running a full node, but they have to live up to very stringent specifications, and they also have to effectively put a bunch of money on the line to say that we promise not to do anything bad. So this is effectively proof of stake. And so they have to put 1,000 Dash into this wallet and lock it up, and they can't spend it. They can't do anything with it. It just sits there, but they earn part of that mining reward, and it gives them the ability to vote on proposals. So they have a lot of impact on what goes on with the currency, and it's basically great for people that are really invested in it and people that really want to see it work and succeed, because they have influence on how to spend the marketing budget. They get to help distribute the blockchain to everyone so everyone can have access to it. And they also provide other important functions, such as the things I mentioned earlier. The mixing service is an optional transaction fee, basically, that you can spend. It's called private send now. So you can do a private send transaction, which will mix it up with loads of other transactions so that no one can see what you're sending. And you also have something called instant send, which is probably the single biggest advantage I think Dash has over everyone else, which is that if you use instant send, you have to pay a slightly higher fee, but the masternodes agree that the miners will take this, basically. They effectively, they see the transaction, they say, you know what, this is important. The miners are definitely going to accept this. You can take this payment now. You don't need this to be put into a block yet, because we guarantee that it will be put into a block. And so what that allows is 2-second transaction times, which means that then you have the ability to use this in commerce exactly like you do with contactless payments and things like that.
We talk about Visa and MasterCard and all that fun stuff, don't we?
It competes with all of it. And the beauty of the whole thing is that the Dash masternodes and the miners, everyone in this ecosystem is getting paid to do it enough that they can scale. So at the moment, if Bitcoin goes to, let's say in the future it goes to 25 megabyte blocks. So every 10 minutes there's another 25 megabytes being added to your PC. And you've got, millions of people connecting to your computer. How can you afford to run that node? It's going to cost you hundreds and hundreds of pounds a year potentially.
And you'll get nothing for it,
and you get
apart from the warm fuzzy feelings. And this is not fair that the miners get everything and you're getting nothing for actually keeping the system alive.
Exactly. And so Dash has replaced that and given people that option. And they've come out with this roadmap that involves insane levels of scaling through hardware on the nodes. So they're talking about custom NVIDIA Tegra GPU architecture and things like integrating with like massive, huge arrays of RAM to compute store all of the data before it can be written to the hard drives, which will be a massive RAID array of hard drives and SSDs. Also that it can keep the network growing really, really quickly, really aggressively without having to compromise on software or anything else, or transaction fees. Most important.
That is amazing. So, hypothetically, then, so someone who is, believes in the network, wants to get involved, they have to, lock in, say, 1,000 worth of Dash, and then they can use, say, a dedicated PC that obviously over time will have to be increased based on, the fact of, over time. But they can participate in this system and get rewarded, and feel part of the system and actually, help it progress.
Yes, exactly.
That is amazing. That is obviously one of the things with Bitcoin, which does shine light on. And then obviously we have the SegWit2 stuff, which I'm sure if we have time to talk about and stuff, this brings on with the, the miners having too much power. And this really does help distribute that and kind of, level it out. And also then the 10% marketing, fund and stuff is just a great way of being able to encode that in. It's like almost encoding its own, kind of survival in itself to keep it going. It's brilliant.
And that fund now is worth somewhere in the region of about $4 or $5 million a month. which is very useful.
Well, I can understand why you're very, very interested in that. That does sound fascinating, and like, because obviously there's other private coins and stuff like Monero, and so have you looked into any of those?
Yeah, Monero is also a great coin. It works in a very different way to Dash, in terms of Dash mixes up transactions, whereas Monero really just secures the actual transaction itself, rather than just puts it into a big, Dash is effectively taking, like, if a transaction is a grain of sand, it's taking that grain of sand and putting it into a bucket with a bunch of other sand and mixing it all around and then sending it out to where it needs to go. Whereas Monero is taking that grain of sand and putting it in a little lockbox and keeping it safe, and then sending it to the other person who has the key to unlock it. That's the best way I could explain it. There's other privacy coins that are good as well. There's a fork of Dash that's called Pivex, which has been around for about 2 years now, 1.5 years, something like that. Which is pretty interesting. Instead of using proof of work, it uses proof of stake for the mining side of it, and it's also implementing more of Monero's kind of technology for the privacy side of things. It's a slightly more privacy-focused version of Dash. Yeah, I mean, there's a bunch of stuff. I could talk all day about them. I think the platforms are probably the next most interesting subset of blockchains, which is things like Ethereum, basically.
And that's it, yeah. So, Ethereum kind of came out because Ethereum, reading up about it, came out of the idea of, I think the guy who started making initial coin offerings, he had a coin. I can't remember exactly. That's it, yeah. And it came from that idea. And then it's this idea of actually making a Turing complete computer on a distributed ledger, which just is amazing.
So effectively, Ethereum is a blockchain that stores more than just transactions. So you can actually write very small contracts on it, effectively like a function in coding. So you could have something that says if someone sends 0.1 Ethereum to this address, then let's create another token entirely, and like so a little subset of data, and we'll send that back across using the same network to that person, to their same wallet address and everything, for them to store. So effectively, that's created stocks. That's created an ICO, and that's how an ICO works. But there's also way more cool things. So some of the really early things that Vitalik himself actually discussed as like possibilities are things like, let's say self-driving cars become really prevalent in the world in the future, and everyone on the planet has them. How do you decide who gets to overtake someone? Well, you could set up a really cool little smart contract between all of the cars where you can pay a slightly higher transaction fee on your journey to your car, and then your car uses that transaction fee to pay other cars to overtake them. And we're talking like tiny, tiny fractions of
micropayments and stuff.
Absolute
that's so cool.
And that's a really cool use case for it. And again, this can all be done through smart contracts. So all you need to worry about is giving a set balance to your car, or not even that. You could actually just say, I want to get there in 25 minutes, not in 29 minutes, for example. And then your car say, okay, well, that'll cost you this much. And then you send it the transaction, and it automatically sends that to all the other cars that it knows already are going on the same route, and pays them to be able to overtake them. Same for toll roads, same for parking, same for, if you take cars just as one example, it applies to so many different things. And that's why companies like BMW and Mercedes are actually both working with blockchain technology, because they understand that eventually there's an ICO. I've kind of gone off on a tangent now, but there's an ICO called ParkByte, right? And this is basically a cryptocurrency token that is designed for parking. So currently, like, the best thing we have in parking in the UK, at least, is the ability to pay on your mobile phone. And
it's like, woo!
Yeah, and that's pretty cool, right? But what's even cooler than that is giving your car a budget, going into a car park, parking in your slot. The car park knows where you've parked, and your car knows the car park. So your car just sends a transaction to the car park for that car parking space for the exact number of minutes that you are in it for. Automatically. There are no tolls, there are no like machines or anything like that. You don't have to send a text, you don't have to do anything, because your car does everything for you. And that's something that already exists and is usable right now. That's actually being piloted around the UK and a few other countries right now. That system. So that's just one example, and one of the early examples of what can happen using these decentralized, effectively token networks, really, smart contract networks such as Ethereum. And there are
So is that using things like the ERC20?
Yeah,
that's the standard for it.
That's currently the standard. There are actually quite a lot of, so there are a bunch of other cryptocurrencies that have their own version of that effectively. And even Ethereum are working on new versions of that kind of token to give it more power and, be able to do more things with it.
So the idea then with Ethereum is you put on, so you have a program that's autonomous that essentially you write it up once and it runs in itself on the actual distributed ledger, and it can do things as it wants. So it's self-regulating because everyone has to agree on it and everything like that. There's obviously been like some problems with it, as you say, the DAO attack and things, because programs aren't perfect and bugs do occur. And unlike a simple web app where you can just push push a fix and it's like all gone. Unfortunately, something like, these smart contracts, they live forever.
Yeah.
So the recoding inside of them has to be extremely watertight. And other things like the parity wallets and things. Would you mind going into some of those, kind of like how?
Yeah, I'll talk about the DAO because I think the DAO is quite interesting because it actually resulted in a fork as well in Ethereum. So the DAO was basically it is exactly what I described the Dash fund as earlier, pretty much. So the DAO was a token that was created on Ethereum, and everyone who owned some of the tokens got voting rights on what to spend the money generated by that network was. What they could spend it on. So the idea was that everyone invests in this massive fund. They have loads of Ethereum that they've transferred to get the tokens that allow them to vote on what to spend the Ethereum on. And they decide to spend the Ethereum on a bunch of startups. That's the idea, right? So they can say, you know what, we really like this project. Let's go and give them some money. We expect it's going to make us some money back in, 2 years' time or whatever. And it was all working pretty well for several months. It actually became the second biggest cryptocurrency behind Ethereum and Bitcoin. So third biggest, not the second biggest. So it was doing really, really well. But importantly, there was a really, really crucial bug in how the tokens themselves were created. And effectively, it was just an order problem in how they had written the code. So normally what happens when you have these kind of these ICOs is that someone sends some Ethereum, let's say, to the smart contract. The smart contract says, oh, thank you for the Ethereum. I'm going to go and store that somewhere else, and then I'm going to send you back the tokens that you've paid for, right, in this new ICO. And it's pretty simple, like a 3-step process, right? But what happened in the DAO is that because it was very, very early, I think it was actually pretty much the first big ICO that had ever happened, aside from Mastercoin and Ethereum itself. They created it in the wrong order. So what would happen is you send the Ethereum to them, they get the Ethereum, they're like, okay, cool. Here we're going to send you the token, and now let's go and store that Ethereum safely somewhere. And so there's a very important problem there, which is that they are securing the Ethereum after they have sent out the tokens. And so someone basically managed to perform an attack on it where they would send the tokens and then cancel it. And of course, at that point, the smart contract realizes that it's received the tokens, so it sends out its own tokens. It sends out DAO tokens. And then it goes to secure the Ethereum, and it's like, wait, it's not here. It didn't actually arrive. Like the transaction,
we can't roll back on.
Yeah, it was a fake, and so the guy performed this attack, lots and lots and lots of times, and generated, at the time it was worth about $20 million or something, worth of DAO tokens, which of course he then sold on exchanges for actual cryptocurrency. So he was acting very quickly to try and make money out of it. And as a result, the only way to fix it, because as you said, contracts live forever on Ethereum, was for Vitalik and the Ethereum devs to agree between themselves, look, we have to just fork off. We have to undo every single transaction that has happened since that attack happened, roll back to the block before it, and then continue. And
it does bring up a bit of a philosophical debate, doesn't it? Where it's like, was that the right thing to do?
Exactly.
Obviously.
That's why it forked. That's exactly why it forked, because a bunch of people who didn't agree with that, around 10% of the community didn't agree with that move. They were like, no, code should be law. People know the risks. They should do their due diligence, and like code is law, and that's how we want it to be. And so they decided to stay on the old chain where the hack had happened. And they still fixed it. They fixed it a little bit later, and things changed, and they kind of went their own path. But it still exists today, and it's called Ethereum Classic. And it was purely because of that ideological belief of no, transactions are meant to be irreversible. If one person has the power to rally a bunch of developers and the community and say, no, we should reverse transactions, then that is not decentralized, and we don't agree
That's
with
it. And that's the brilliant thing with being open, is the fact that you have this decision, to go off and start your own one then that has this history. And its own belief. It has the previous history of Ethereum, before, but then it has its own history, own future.
Yeah, exactly.
But obviously, it makes it very confusing for people to come into the space because if you don't understand what a fork is, it gets very, confusing.
I mean, there are a lot of people that I see on a daily basis that come on and they buy Ethereum Classic because they think it's Ethereum, and I'm like, no, that's not Ethereum. And the same is happening increasingly with Bitcoin now, because you've got Bitcoin Cash and Bitcoin Gold, and people.
I was gonna kind of move on to that, actually, where the scale, because actually one interesting with Bitcoin, you say code is law, and that is that's the beautiful thing with Bitcoin, is the source code is the contract, is the law. Whatever's written in that source code for Bitcoin is how the protocol works. There's not a written up white paper on how exactly it should work. It's the source code that actually is the actual defining document, which is just a fascinating way of thinking that code is law.
Yeah.
But moving on, with Bitcoin then, and you mentioned scaling, and scaling is the biggest thing. With the more popularity, the bigger it gets. I think we're on I don't know how many gigabytes now. It's like 107 gigabytes, maybe, the whole blockchain at this time. I'm not 100% sure. But obviously that puts a lot of intents on kind of storage for people like who want to host the node and stuff. But one of the big things is obviously like getting up to the Visa and the MasterCards. And if you're believing Satoshi Nakamoto's initial dream, which was that this can be used as a day-to-day currency, we need that. Obviously, it's fine if I think it's the 6 confirmation rule, where, we can, I'll send you something, maybe it's online transaction. I'll try, I'll send it to you. I'll wait an hour. I'll confirm that that's a thing, and I'll send you the good. But what happens if it's something for like a newspaper or something quick? We need those quick instant transactions. And one of the naive ways of doing this, short-term naive approaches, is to increase the block size. And that's how something like Bitcoin Cash came about. So you've just mentioned that. So what actually then is Bitcoin Cash, Bitcoin Gold, and bog standard Bitcoin?
So we mentioned before about the blocks and the block sizes, and how a block is made up of transactions. So every transaction takes up space. And currently, with default Bitcoin, the way it was created, it has a 1 megabyte maximum size for blocks. And so effectively, if let's say every single transaction is 1 millionth of that, then you get 1 million transactions in that time. So it's been calculated that Bitcoin can handle roughly 3 transactions per second in total, if you count up how many go into all of the blocks and how many blocks there are in an hour, or in a second in this instance. Now that obviously is nowhere near enough to compete with the likes of Visa and MasterCard. And so Bitcoin, the vast majority of the community decided we want to work on this new technology called SegWit and Lightning networks. And so SegWit, segregated witness, is effectively kind of compressing transactions. It's taking a bunch of the data from within transactions and saying, you know what, we don't really need to store this the way we are. We don't need to store all of this data in each individual transaction. We can store it in the overall block, for example. And things like that.
And like transaction malleability and things like that, the problem of being able to identify transactions.
Yes. And so it fixes the transaction malleability problem, and it also, at the same time, makes the size of the current block more efficient, basically. It actually slightly goes over the size, but that's a bit too complex to explain right now. But it goes slightly bigger than 1 megabyte in reality. But it allows for these things to happen. And most importantly, it allows for Lightning networks and side chains. And so these haven't really been built out yet, but effectively it's a bunch of off-chain transactions. So your transaction doesn't necessarily happen on Bitcoin, it happens somewhere else. You can do payment channels. And basically what happens is, let's say you're using Coinbase, right, which is a really, really popular Bitcoin exchange and wallet. If you're sending your money to someone else on Coinbase, do they really need to send that information to the blockchain? Or do they just need to collate 20 transactions at a time on their own, add them all together, and then put that transaction on the blockchain? And so you can have this system whereby you're putting more and more transactions effectively into a second layer network that communicates with the original layer, which is Bitcoin's blockchain. Some people disagree with this because they think that it's asking for trouble, and people could, in theory, steal coins and do dodgy things on their own side chains, their own transactions. So Coinbase could lie, and they could maybe
because you're using third parties again. You're kind of
Exactly.
bringing in a layer of trust, aren't you?
Exactly.
Again.
Exactly. And so that's kind of the problem. But some of the other things that it allows is atomic swaps, which is done via the blockchain and can kind of work with side chains that are already existing, working, open source cryptocurrencies. So the example for this is Litecoin. So Litecoin was one of the first I think it was actually the second cryptocurrency created after Bitcoin. It's exactly the same as Bitcoin in almost every regard, except that they've got 4 times as many coins total supply, and their block time is only 2 minutes. And pretty much apart from that, it's almost identical. They have a bunch of the same devs that started on Bitcoin and moved over to it. And
good old Charlie Lee.
Yeah, Charlie Lee, who is an absolute legend. You should definitely follow him on Twitter. He's amazing.
Oh, hell yeah.
And basically, Charlie's philosophy for Litecoin right at the start is that, Bitcoin's going to reach this point. It's going to reach this point where there's so many people wanting to use it that it just can't handle the volume. So I'm going to create another currency called Litecoin, which is almost identical to it, but faster. It's just faster, and it's smaller units, and it's easier for people to kind of handle. And he's always said the same thing for like 5 or 6 years now. He's been using the same phrase, which is that you use Bitcoin to buy houses and cars, and you use Litecoin to buy. And now that the atomic swap transactions have been enabled, you can actually use the Bitcoin network to pay for things in Litecoin, and vice versa with Litecoin. It will automatically convert Bitcoins to Litecoins.
That is mind-blowing.
So you do a transaction, it collects your transaction, a bunch of other people's transactions, it automatically converts it to Litecoin once you've got a big enough amount. And then it uses that to spend it or whatever, and then the same happens in reverse to get you money back and things like that. So it's really, really, really ingenious, and I think that is definitely probably the biggest reason that you should own Litecoin. I would say. But yeah, it's super, super interesting. There's a bunch of other things that it potentially enables, like channel payments, which are a bit more complex, where if someone's already paying someone, you can jump into their transaction and include your transaction in their transaction, and things like this, which are really complex. It's working on a few altcoins, but it's not working on Bitcoin or things like that yet. So I think effectively Bitcoin and Bitcoin Cash, the big difference is that Bitcoin have said we want to take a software approach to this. We don't believe that making hardware more important and stuff is going to be worth it, because we think that people will stop wanting to support the network because it will cost too much. We want to do everything in software. Whereas Bitcoin Cash has said, no, we need to just make things bigger.
And keep SegWit away so we can do ASIC stuff, so we can still have our advantage.
And yes, we can still use our sneaky ASICs that are kind of cheating.
Oh, good old Roger Ver. No, that's really interesting. And then the other one, obviously, is Bitcoin Gold, which is just, came about. And what's the kind of impetus behind that?
So Bitcoin Gold is actually probably the simplest of all of them in terms of what it wants to change. Bitcoin Gold is basically just wanting to change mining. It thinks that mining has become too unfair and that it should have stuck with being viable on graphics cards. So basically, it stopped being viable on graphics cards because people found a way to use the exact mining algorithm that they've chosen to make it more efficient to use on something like, a big custom-built computer, basically, like a server almost. And so people started making more and more servers, and you have like these massive farms that cost, millions.
They are something amazing, aren't they?
Yeah.
Like looking at some China mining farms they are just insane.
Yeah, and it costs basically the level of entry, the bar to entry for getting into mining cryptocurrencies. You can't do it off your own PC. You have to invest something that you wouldn't normally own in order to start doing it. And it means that there are less and less and less people actually doing it. So you have these massive companies that are run by 4 or 5 people, and there's 10 of them, and that's it. That's your Bitcoin network. It's 10.
And that kind of
10
goes
companies.
away again of the distributed kind of everyone's equal,
Exactly.
this flat network.
Exactly. And so Bitcoin Gold has basically said, look, we found another algorithm that's being used by Ethereum and a bunch of other stuff that we want to use, which means it's still mineable on graphics cards. So we're going to change the Bitcoin code. We're going to fork off, change this one thing so that it's a different algorithm. That means that people will mine on graphics cards, which means there'll be more miners, which means it's fairer for everyone and more decentralized.
And obviously with this, then, we all get free currency. I mean, this is the funny thing, and this is where some of like the spikes happen, is everyone goes, well, you get free money with the fork because, magically, obviously it's forking off the chain, the current blockchain, because the nodes software is changing so much that we now can't use old and we can't interact with the old software, like saying using a different, hashing algorithm or something. We split off, and now I've got some Bitcoin Cash and some Bitcoin Gold. And if I'm lucky, obviously you have to keep your own keys and all that fun stuff. As long as you have ownership of it, you're not in control. You don't have the parties who actually have control over it. You can do these things. And I think that's where a lot of the confusion happens. And I do think that we're going to be getting more of this. Do you think before we kind of stabilize, there's just going to be a lot more explosion of different forks and different ideas on people just trying to get on the bandwagon of the name Bitcoin because people don't like calling it Bcash and things like that? What's your opinion on that?
So I think actually we're almost at like the peak of Bitcoin forks right now, I would say. So I think we've probably got like 3 or 4 more to come. Like there's Bitcoin Diamond coming up, for example, which is like a combination of all of the others. And it's inevitable that there's going to be a few more as well. But I think that the community is beginning to really reject this. And especially like the wider cryptocurrency community is saying that this is getting ridiculous.
It's like, how do you tell your mum that there's Bitcoin Cash and Bitcoin Gold and all these other things if when you just want Bitcoin?
Yeah, and that's the big thing. Like Bitcoin Cash, a lot of people that have heard nothing about blockchain and Bitcoin and how it works would just think that Bitcoin Cash is maybe like the ones that you can spend. Maybe you can't spend
Yep.
Maybe Bitcoin is the savings account and Bitcoin Cash is what you spend every day. Maybe Bitcoin Gold is when you invest it. So these names are definitely confusing, and I think they've been made confusing on purpose, to be honest. I think that's how these guys plan on pumping up their coins. And the important thing about these forks is you really have to look at the motives for why they are creating these forks and exactly the specifications of the fork. So Bitcoin Cash was created to increase the block size and stuff, blah, blah, blah. They've been debating that for a long time. It's kind of a legitimized fork because a lot of people do disagree with using SegWit because of the things we mentioned earlier, that potentially it can affect decentralization, even though their method also affects decentralization.
Yeah, that's the funny thing.
But in a different way.
It doesn't appeal to them. It obviously doesn't hurt them.
Exactly. So you can kind of understand that one. You can kind of get behind it. But you've also, if you look at all of the people right at the top of that, the big figures such as Roger Ver, John McAfee, the fake Satoshi Nakamoto. If you look at all of these guys that are at the top of this and involved in it, Jihan Wu, they're all people that own huge, huge, huge amounts of Bitcoin. And so when it splits, they're doubling their money. That is their motive.
They can switch between the two, and they can just transfer between the two to keep the prices going up and down.
Exactly, they can manipulate because the market cap on Bitcoin Cash is so much smaller than Bitcoin, and they combined own so much Bitcoin that they can convert all of their Bitcoin to Bitcoin Cash, make the price go up by 3 or 4 times the value. And then everyone else buys in thinking, oh, this thing's going up. Maybe it's going to take over. Maybe it's working. And then they convert it all back again. And they're just making free money out of people. That's what I genuinely believe is happening with Bitcoin Cash. There are people that would disagree with me. And I can definitely understand people thinking that they don't like SegWit and they want to go down that kind of scaling route. But my retort to them is, why don't you use something like Dash instead then? because
absolutely
they have fixed that problem already, and they are already a big cryptocurrency. They're almost as big as Bitcoin Cash, and with Bitcoin Gold it was a different approach. Bitcoin Gold actually did something that a lot of early cryptocurrencies did, which is something called a pre-mine. People used to call it a pre-mine scam, where someone would create a coin and they'd pre-mine without giving anyone else access to the network, they would pre-mine, let's say, 1 million of the 21 million, and then they'd let other people join. And this is
So they've already got a good foot in.
exactly, and this is actually what Bitcoin Gold did. So they did the fork, and then they didn't give anyone access, and they mined it. They sat there mining for a while, and now they've given people access. And so you have this situation where they've made loads of money from this already. They're out. They don't care if it succeeds anymore because they've made their money. They're going to just go and exchange that for Bitcoin or for another cryptocurrency, and they don't care about the project anymore. So even if like the ideas sound good, you really have to like dig under the surface and look at what are the motives for the people building this. Where is their money? Where is their money sitting on this? What is their incentives for doing these actions?
No, absolutely. It's so interesting, and I think we've just hit over the hour mark, so I'll try and keep it short and sweet for the end. I'm really sorry, man. I know you're busy. You've got a busy day. Couple of quick ones, like we mentioned private keys. Like, how do you store your private keys? What's your kind of way around that?
So I generally try very hard not to store anything on an exchange for a very long period of time. Effectively, the rule is if you control the key, then you control the money. As simple as that. You should never give your key to anyone. It's like a password, but even worse in a lot of ways, because you can change your password, but you can't really change your private key. You have to send a transaction from it. So what I generally do is I have backups of the private keys that I have paper backups, and I also have backups on cloud services that I trust that are also then encrypted. and I just use a general purpose wallet. So the main wallet I use at the moment is Exodus, actually. And it's a bit risky because someone could break into my house and they could steal my PC, but they would still have to unlock my PC and then unlock my wallet. So they've got to break.
There's a couple of levels there, isn't there?
There's a few levels there. But
have you looked into any hardware wallets?
Yeah, so hardware wallets are really, really good if you want to just hold long term. But obviously, I'm more of a trader, so I quite actively move things around. And I'm at my PC every day as well, so hopefully I would spot someone trying to steal it.
Like, what are you doing here?
And of course I have backup keys, so even if someone stole my PC, I could very quickly just download the key, move the money, and they've got nothing to move. But yeah, hardware wallets are really useful for if you want to store long term. I would still say definitely make sure you keep backups of the private key somewhere else as well. You could even use 2 hardware wallets or 3 hardware wallets if you wanted to. They're pretty cheap. Like there's the Trezor is one that's pretty common. What's the other one called? I can't remember now.
Ledger.
Yes,
Ledger Nano.
Ledger Nano and Ledger Nano S. Yeah, those are both really good. Yeah, I mean, I've not really had that much experience with them. I used one of them once, and it seemed pretty easy to me.
No, it makes sense. I mean, obviously you're trading, so you want a hot wallet that you can move things in and out of.
But if you are someone that is really, really not techie, in which case it's kind of weird that you're listening to this podcast.
Hello, welcome. I think we've confused you for the last hour and 7 minutes.
I hope you've enjoyed it. But if you are someone that doesn't really trust yourself that much tech-wise, you're the kind of person that every time something breaks on your PC, you just give it to someone else to fix. Then it's probably better for you to use something like Coinbase in reality.
That's it. And they've got their own cold storage kind of vault systems and stuff, don't they? So at least you entrust in them. If you can't trust yourself, at least trust someone who you feel is going to be more strong, more quick than you. Now, and finally, like I couldn't have you on without talking about like the day-to-day life of a trader. Like, what does your day consist of? I'm fascinated by it.
Of reading lots and lots and lots and lots and lots of white papers. And news and everything else. So as I mentioned, the 2 different schools earlier, I think I lean quite heavily towards fundamentals, thought experiments about where things are going. Exactly the kind of thing we just talked about with Bitcoin Cash and Bitcoin Gold is the kind of research I was doing as soon as those things were proposed, thinking, okay, how's this going to evolve? What's their plan? How do they make money out of this? Is that against how I can make money out of it? So there's a lot of that. There's a lot of looking at charts and looking at numbers going up and down. But
you've got that awesome, was it 4 monitor setup?
Yeah.
Which I'll have to put I'll put in the show notes that you link to your website where you've got it. It looks badass, man.
Yeah. So yeah, I basically, I have 2 screens of charts on it all the time. I have my main screen for my eToro, which is where I do most of my trading. And then I have a second screen for everything else. So I live stream because I trade on a social network effectively called eToro. And the purpose of this network is that you can follow other people's trades, you can post, comments and information and thoughts on things.
How do you find that, by the way? Does it add pressure, or like do you kind of just make it be part of your day-to-day life?
I think so. When it first started, I felt quite pressurized in the first month or so where I was getting more and more people copying me. But I feel entirely fine.
And then your dad copied you, and then you realized, oh crap, now I've got to be good.
Well, the thing is, I was managing his investment before I started using eToro. I started managing his investments for him anyway, and then I stopped and went onto eToro, and then he kind of came back to me on eToro and joined eToro as well.
So I know that guy.
So yeah, no, he's pretty happy with my returns. But yeah, eToro is basically like Facebook for trading. So you can post loads of stuff and you can look at everyone's profile and you can see all of their trades. You can see their stats and stuff. You don't see how much money they've got, but you can see the percentages. And by pressing one button, you can copy someone. It's called copy trading. And there are loads of good investors that trade in lots of different things and stuff. I actually copy a few other people myself on my second account. But yeah, so I have about 10,500 people copying me right now.
That is pretty amazing.
Which is $17.5 million of other people's money that is copying.
And you're just sitting at home in front of a couple of computers, reading some white papers and making those decisions. That is so cool.
Yeah. What a weird world we live in.
I know, well, it's a great world, isn't it? Absolutely. I mean, talking about cryptocurrencies and all this, it is absolutely amazing.
Yeah.
Oh man, but so thank you so much, dude, for coming on the show. I'll put all the things in the show notes, things about like eToro and stuff like that. And you're more than welcome back on any time, man, because it's just been super awesome to chat to you about this stuff.
Cool. Well, hopefully everyone else enjoys it as well.
All right then, audience. Well, it's been another great episode, and we'll speak to you again next week. Goodbye.
You've been listening to 3 Devs and a Maybe. You can contact us at contact@3devsandamaybe.com or follow us on Twitter at 3 Devs and a Maybe.